What is a recession risk and how does it impact your investment strategy? Recession risk is the risk of an economy entering into a period of economic decline, usually associated with a decrease in GDP and an increase in unemployment. Recession risk can have a major impact on your investment strategy, as it can cause stock prices to fall and interest rates to rise. It is important to understand the risks associated with recession and how they can affect your investments so that you can make informed decisions about where to invest your money. In this video, we will discuss what recession risk is, how it impacts investment strategies, and what steps you should take to protect yourself from its effects. What is recession risk? Recession risk refers to the chance of a U.S. economy falling into a recession, or economic contraction, within the next few years. A prolonged economic slump can be particularly harmful if it lasts for more than 2 years and leads to rising unemployment, a sharp decline in consumer spending, and falling asset prices.
Understanding the different types of inflation and how they impact your investment portfolio. Inflation is an important economic concept that can have a significant effect on your investment portfolio. It's important to understand the different types of inflation, how each type affects the economy, and how they can influence your investments. In this video, we'll discuss the different types of inflation and their implications for your investments. We'll also look at how you can use this knowledge to make informed decisions about your investments in order to maximize returns and minimize risk. What is a buy and hold strategy? A buy and hold strategy is a long-term investing strategy that seeks to maximize the accumulation of capital. With this strategy, an investor does not trade stocks on a regular basis, but instead buys a stock or a mutual fund for their portfolio for the long term. Stocks are bought in the company's current price range with no attempts made to sell them before they decline so that short-term gains do not significantly impact overall gains from the investment. During periods of low market volatility, such as during bonds rally or while fundamentals remain unchanged, investors will often wait out corrections in order to avoid having to sell despite a steep decline. A correction is defined by the SIBO as when an index falls 10% from its high point the previous day. How to analyze market trends and make investment decisions during a recessionary period. During a recessionary period, it is important for investors to understand the market trends and make informed decisions that will bring them maximum returns. Analyzing market trends can help investors identify opportunities and risks before investing their money. It is also important to understand the macroeconomic factors that influence the stock markets during a recessionary period. By analyzing these macroeconomic factors, investors can make better decisions on when to enter or exit the markets. Additionally, they can develop strategies that will help them minimize their losses during this time. By understanding how to analyze investment strategies to mitigate risk during a recessionary period. During a recessionary period, it is important to have an investment strategy that can help mitigate risk. Investing in stocks, bonds, and other financial instruments can be very risky during a recession. Therefore, investors need to be aware of the various strategies available to them to reduce the risks associated with investing during this period. One of the most popular strategies is diversification. This involves spreading investments across different asset classes such as stocks, bonds, and commodities in order to reduce risk exposure. Investors should also consider alternative investments such as real estate or commodities which offer some protection against inflation and currency devaluation during a recessionary period. Additionally, investors should consider investing in defensive stocks which are less volatile and tend to remain relatively stable even during times of economic downturns. By following these strategies and keeping an eye on the markets, investors can protect their capital and maintain their long-term investment goals even during a recessionary period.